I'm going to be talking about asset tokenization over Bitcoin protocols generally today, but more specifically also over the Lightning Network in the second half of this presentation. Just as a heads up, I've got some notes here on my phone. I don't usually do this, but I traveled here from San Salvador, 45 hours door to door. I'm still very jet lagged. I don't know what day or time it is, so I hope you'll forgive me for looking down my phone every now and then. So first of all, let's ask ourselves what is even asset tokenization, and why should we tokenize assets in the first place? I think a lot of us, when we hear the word tokens, we think of shitcoin casino scams that have been horribly prevalent over the last few years, especially since the 2017 ICO boom. Just to be clear, that's not exactly what I'm mostly referring to when I talk about asset tokenization. I'm mainly referring to something else. I am talking about the comeback of a type of bearer instrument, which is an asset class that was very common up until roughly the second half of the 20th century, which is more or less when it was effectively outlawed all over the world. There's still a very common kind of bearer instrument today that still survives to this day. It's cash, although that, as we know, is also very problematic to the powers that be with the war on cash and the push for CBDCs and so on. But in fact, many of the same arguments for why money should be a bearer instrument also apply to other assets, such as financial obligations like debts or equity and commodities. And there's already an emergence of these bearer digital assets. I've listed a few examples here that trade on Blockstream Liquid. There's the Blockstream mining node. There's the Infinite Fleet, SideSwap, the Aquarius Fund. But wait a minute, didn't I just say that these bearer instruments were effectively outlawed in the second half of the 20th century? Well, it's true that most issued instruments, such as shares, must be registered in most jurisdictions, which means that there's always going to be some sort of a central record keeper of who has bought what, and there's not really a way around that today. As such, the security tokens that I just mentioned over Liquid, you could argue that they're not really bearer instruments either. But I'm here to make the case that they constitute a sort of hybrid and that they're a lot closer to bearer instruments than what we have today with stock exchanges. To understand what I mean, there's a sort of open secret that I need to let you in on stock exchanges. Anyone care to guess what that might be? They don't actually sell stocks. That's right. It sounds incredible, but whenever you buy shares of a company on the New York Stock Exchange or NASDAQ, you're not actually becoming a partial owner of the company that you invested in. They want you to think that, but instead there's a little-known company that you've probably never heard of, quote-unquote private company called SIDECHAINS, which physically owns and stores all of the physical certificates for all of the publicly listed stocks in the United States on behalf of a government institution called the DTC, the Depository Trust Company, which works with a lot of brokerage firms who are actually the ones that are keeping track of what you've bought and therefore what claims they can make on SIDECHAINS on your behalf. So that's right, the USA is actually a communist dystopia where the government basically owns everything, and where the government they give people the right to be beneficiaries and think they have ownership only until it becomes inconvenient to them. So this chain of intermediaries means that it takes a few days to settle stock transactions, and therefore nobody can actually tell you how many shares of a given company are truly on the market at any given time. Brokers end up lending shares that don't really exist, creating massive artificial short pressure on the market. This is a practice that's known as naked short selling, and it's technically illegal, but the whole financial system is built on it and makes it inevitable anyway. So, by the way, I've made just to make a note here that I'm focusing on the US, and part of the reason for that is that one of my inspirations for all of this is Patrick Byrne. He's been one of the biggest, most steadfast warriors about this, making this known, talking about the concept of naked short selling. And although admittedly he's shitcoined a little bit on the way, I think that he's still a hero for talking about these things, and he's one of my great inspirations. But yeah, basically this is how it works all over the world, not just in the US. And nobody really knows what the true cost of this has been on society. I mean, how could you accurately estimate the actual level of negative externalities that all of this creates, and how different the world could be if it wasn't for these distortions? Just like nobody can really tell you how different the world would be if we didn't have central banks or fiat currencies. But the one thing that we know for sure is that these pernicious power structures affect the entire world, but only serve a powerful few. So now with security tokens, although like I said, your ownership of the token probably still needs to be registered in the jurisdiction where it's issued, listed, and traded. And there are already a few virtual asset service providers that step in and take care of compliance, making sure that such assets can be in line with existing securities regulations. The difference is then with the existing stock market system today, that it's possible for you to actually own the shares, which means that the entity that issued it could potentially decide to change jurisdictions, up and leave, delist it from certain markets, listed in another one. And as long as the issuer still recognizes these tokens as legitimate shares in their company, they'll be transporting you along with them in their change of jurisdiction. That means that the government has a lot less leverage on them, and it opens up the door for a lot more competition in governance between jurisdictions, which is another really exciting trend that's going on besides the decentralized internet. Decentralization in governance. There's Bitcoin City, there's the ZAs in Honduras. There's a lot of experiments in governance right now that go hand in hand with everything else that's going on. So one obvious possible problem with actual self-custody is that, well, if you have a token in your wallet and you can send it to whoever you like, that makes it very difficult to comply with regulations and reporting requirements around changes of beneficial ownership. If you try to solve that by giving centralized exchanges full custody, then in a sense, you're really just recreating the old system that we had before, and it sort of defeats the purpose of tokenization. You could argue that there's still some utility in it because of you could make it easier to show proof of reserves, and there's more transparency on an open ledger and so on. But really, it makes it a lot less exciting, and I think that's why, in part, there's been so little liquidity and action around security tokens so far. But there's a very easy solution to this. It's nothing really groundbreaking or very new. You can do that pretty much on any layer 1 blockchain today. It's called access control lists, ACLs. When you issue a token, you could put a white list of addresses, and basically, it's a way to transfer the burden of compliance from centralized exchanges to token issuers or their designated third party, like the virtual asset service providers, so that you can still enforce compliance with securities regulations while still allowing a form of self-custody. That's something that's closer to a bearer instrument that allows peer-to-peer exchanges between whitelisted addresses. So now, very briefly, here's a few of the use cases for asset tokenizations. There's stable coins, tokens backed by cash or other assets. There's securities, stocks, bonds, and other instruments or obligations like debts. NFTs for non-fungible securities like real estate, badges, certificates, prepayment like promo codes, discount vouchers, and like I said, peer-to-peer exchanges, trading without intermediaries. So, so far, tokenization on Bitcoin protocols is still fairly insignificant for reasons I'll get to in a few slides. Yet, Bitcoin still plays a huge role in the tokenized asset market, or the so-called decentralized finance. Which is decentralized in name only, as we know. But still, even shitcoiners know that Bitcoin is the best risk hedge and store of value, and that's why it holds such an important place on Ethereum and other shitcoin chains, because there's huge demand for this, even despite the huge counterparty risk that you have when you're trading WBTC, because anything could happen to the custodian, and also the risks inherent to Ethereum itself. Now, despite all of this, there's still a huge amount of volume there, and here's some data we collected last September. Bitcoin derivatives market cap on other chains is roughly 8 billion. There are 289,000 Bitcoin locked on derivatives on Ethereum. And if we could move all of that directly to Bitcoin, that would do a lot to making these shitcoins obsolete and fixing a lot of inefficiencies. Here's some more data from August 2020 that shows fees collected on Ethereum. There were 200,000 daily USDT transactions. That was roughly 15% of fees collected. The majority of fees collected were from other types of contracts. But even there, still, you see that DEXs like Uniswap, whose biggest pairs are stablecoins and Wrap Bitcoin, were a majority of that. So just imagine if it was easy and cheap to do all of this directly with real Bitcoin. Not only would, like I said, that make Ethereum and other shitcoins obsolete, but I also think personally that this is one of the last missing pieces of the puzzle to achieve hyper-Bitcoinization and, to put it bluntly, fix the world. Now let's get a little bit more technical, get into the actual meat of things. In this section we'll talk about the different approaches to tokenization and where Lightning comes into all of this. So first there's shitcoin chains, and I think given the audience here I don't need to spend much time explaining to you why they're bad. They always enforce some sort of alternative currency that's not Bitcoin as their transaction fee or gas token. These can never really compare to Bitcoin in terms of their quality as monetary assets. So they instead focus on really dumb narratives like on-chain capacity and speed, which leads to a lot of centralization, bloated on-chain order books that enable front running and so on. It's bleak, basically. But if we look at Bitcoin, which is actually where the origins of tokenization came from, let's have a show of hands. Who here has been around for long enough to remember colored coins? Right? There's quite a lot of you. So everything started really with colored coins. You know, taking a Satoshi, making that represent something else, and that was really cool for a while. But the problem with that is that every single asset transfer required a Bitcoin transaction. And so another similar protocol came a few years later, Mastercoin. That's where USDT, the most valuable, most useful token today, was first issued. They later rebranded to Omni layer. And still that required a Bitcoin transaction for every token transfer. That very quickly proved not to be scalable. Fees shot up quite significantly. The chain was congested. And that's roughly the time where Ethereum also took off. We then had also the block size wars. People argued that bigger blocks would allow Bitcoin to remain the standard protocol for tokenized assets. And but we, as a community, and I think very rightly so, decided that smaller blocks and therefore a more widely distributed network was preferable, despite the limitations on how much you can do on chain because of that. Then there was the advent of the Lightning Network, and that cast a new ray of hope for on-chain tokenization, as the thought was that if we can move most of the transaction throughput for asset transfers to the Lightning Network, on-chain tokenization might be viable and scalable. The first mover here was once again Omni layer with their Lightning specification OmniBolt. The first USDT transaction was made through OmniBolt last year. That was very exciting. Then some newer innovators in the space like Taro and RGB, my personal favorite, also came along with more efficient use of the space they take up inside of Bitcoin transactions compared to Omni. And also slightly different takes on privacy. Yet with all of that, there are still some intrinsic drawbacks that all of these Lightning tokenization protocols have. And that's mainly in the fact that they still require the use of on-chain Bitcoin transactions, at least at least before these assets can be traded on Lightning at the point of issuance or channel management. And indeed, with Taproot, you can batch a lot of these transactions inside of regular Bitcoin transactions. So if you were going to make a Bitcoin transaction anyway, you can basically add your asset transfers without that taking up really any significant additional space. Unless you're a centralized exchange and you're already regularly and consistently making a lot of frequent Bitcoin transactions, it's probably still going to mean that a lot of average people are going to be making Bitcoin transactions only for the purpose of transferring tokenized assets. So that results in asset transfers that compete against monetary transfers for space on the Bitcoin time chain. Then on top of that, not every tokenized asset is always going to have enough liquidity to justify using over Lightning. Like I said, channel management still takes up space on chain, and there's also transactions for asset issuance. And I think in a world that's really hyper Bitcoinized and where every asset or financial instrument was represented by a token for the purpose of trading it against Bitcoin, that's probably still going to reach a bottleneck and not ultimately scale. And so that's why we get into my area of expertise, which is Bitcoin sidechains. Now looking at some of the sidechains that already exist on the market today, you've got Rootstock, which is basically just an Ethereum clone that uses merge mining and pegged Bitcoin as its native fee currency. This approach suffers from a lot of the same problems as Ethereum, being an account-based complete blockchain with a lot of useless bloat and front-running. But it even also introduces some new vulnerabilities compared to Ethereum in that merge mining is a very difficult process to really get started up. It's opt-in. It's mostly going to give governance power to mining pool operators. These operators don't necessarily really have a real stake in the sidechain. And so there's not real disincentive not to perform an attack, at least as long as sidechain revenues are low. Which is kind of a paradoxical situation or catch-22, which prevents the sidechain from seeing any real adoption. Then there's Liquid. I'm going to say quite a bit more about it later, but for now, just it's architecturally a lot closer to Bitcoin, which is good. But one of its drawbacks is that it's got a very centralized block issuance mechanism. And therefore, it makes it partially vulnerable to state-sponsored attacks. Even though we'd all hope that Blockstream would never have to face those, it will probably inevitably happen one day. And then finally, there's Stacks. And no, I would like to be generous to them because I think Munib has a great personality, but honestly, I don't think it really brings much new to the table. It has a pointlessly complicated consensus mechanism that doesn't really achieve anything except gain affinity with Bitcoiners, and yeah, that's really all on Stacks. The great drawback that all three of these have relative to on-chain tokenization is that they all require some sort of representation of Bitcoin on the sidechain. They can't truly interact with Bitcoin on the main chain. So you can't swap tokens issued on these chains peer-to-peer for Bitcoin, neither on-chain nor using Lightning, unless you're willing to wait a relatively long time for the cross-chain swap to settle, like using SideShift on Liquid, or if you're willing to risk losing one side of the transaction to a potential reorg on Bitcoin if there's an orphan block. So instead, you're pushed to use RBTC or LBTC or SBTC. The first two are required for any transaction on their respective respective sidechain, but Stacks is even worse because they enforce their own shitcoin STX. On one hand, like with wrapped Bitcoin, these pegged Bitcoins at least have some degree of counterparty risk. They're never really as trustless as using on-chain or Lightning BTC. Although admittedly, with some proposals like the IP300 or dynamic federations, this counterparty risk can be minimized significantly. The fact still remains that you still need to teach people to use a new kind of Bitcoin, whereas whereas the on-chain tokenization protocols that I mentioned earlier allowed you to do everything directly with the forms of Bitcoin that we are most familiar with currently, on-chain and Lightning. So finally, we've reached the part of this presentation where I show you the project that I'm working on. It's called Sequentia. It's a new Bitcoin sidechain that's going to be that we're planning to build using Elements, the same platform that Liquid was built on. Which is, like I said before, very close to Bitcoin Core. It's actually an extension of Bitcoin Core. But there's 3 key changes that we're making to Elements compared to the version that Liquid uses. So the first change is that we're anchoring sidechain blocks to Bitcoin blocks. What that means is that every block on the sidechain will have a reference to a Bitcoin block. The rule is that it has to be at an equal or higher height than the Bitcoin block referred to by the previous sidechain block. There could be several sidechain blocks that refer to the same Bitcoin block because we'll have a higher block frequency. But the point is that if there's an orphan block on Bitcoin, all of the blocks on the sidechain that refer to that block will also be discarded. And that means that you can from the first Bitcoin transaction, rely on a cross-chain swap you've done between the 2 chains, because if the Bitcoin transaction gets lost, then the sidechain transaction that corresponds to that swap will also be lost. That's the first change. That really kind of changes the whole use case and purpose of the sidechain compared to Liquid, and also means that we don't really need a pegged Bitcoin anymore. So the second change is that we're removing the pegged Bitcoin as a native fee currency, and we're instead introducing something we call a free market for transaction fees, where basically any user can pay their transaction fees using any token issued on the sidechain, as long as there's a block signer that's interested in that token enough to create a block that includes their transaction and collect their fees in that currency. So for example, if all that you have is USDT and you want to sell that for Bitcoin, you don't need any third token. You'd just pay your sidechain transaction fee with USDT. And then you'd get your Bitcoin, which is more or less the same kind of user experience that you get with on-chain tokenization. Now, obviously anyone can issue a pegged Bitcoin on Sequentia, but no pegged Bitcoin will have any sort of preference over another, like LBTC does on Liquid or RBTC on Rootstock. So another difference, and this is where I possibly lose many of you, is that we're opening up the block signing federation to the public so that it's less vulnerable to state-sponsored attacks, so that anyone can join the federation and become a block signer. There's going to be a token associated to that, but the whole idea is that we're not enforcing this token on end users. It's not supposed to be money. It doesn't give you any sovereignty or over the network. You can't change the consensus rules, even if you have all of the token supply. It's just an asset that you can acquire on a DEX without doxing yourself in order to join the block signing federation. Finally, here we have a comparison table of all the technologies I mentioned. It doesn't display very well on the screen, but anyway, if you'd like to take a closer look, I'm sure the slides will be available, or you can email me and I'll send them to you. I have a little bit more information on Sequentia here. Obviously, the whole thing is supposed to be an add-on to Bitcoin. It's supposed to complement Bitcoin. So a Sequentia wallet will be first and foremost an actual Bitcoin wallet. From your Bitcoin seed, you can generate a sidechain address, and from there you can enter a DEX and acquire stable coins with Bitcoin. Open Lightning channels with those stable coins, and then go on a Lightning DEX and perhaps do high frequency arbitrage between USDT and Bitcoin. That's probably one of our first suggested use cases. We inherit a lot of the technologies that were made for Bitcoin, like CoinJoin, signature aggregation. Obviously, here it can be made even more powerful because you can have different outputs than inputs, so that you could get even a greater privacy. That's roughly what a Lightning swap would look like on Sequentia. you know, Alice and Bob both have Lightning channels with each other in BTC and in USDT or USDC or whatever asset on Sequentia. We can send each other Bitcoin and USDT, exchange the secret to unlock the tokens, and what the anchoring does here that you wouldn't get on Liquid or on other UTXO blockchains is that if there's a breach remedy, a closure event, then that's going to be enforced on both chains, even if there's an orphan block on Bitcoin and a reorg as a result. So again, with the free market for transaction fees, you can pay your transaction fees with any token. That's something that's technically already possible with a lot of other protocols. Like you could basically on any blockchain, you could get in touch with the block signer, whether that's a miner or a staker, depending on what blockchain you're using, and pay them off chain to include your zero fee transactions. But what we're doing is basically making it that more efficient by moving it to the protocol level, so that's actually the norm, and rather than a third-party service that you need to acquire. So that's roughly everything. You can find me at Andreas at Sequentia.io, and I'll be taking questions now if you have any.